Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me on the show today, I've got Alex Wright, Manager of Fidelity Special Situations and Special Values. Alex, welcome to the show.
Thank you.
Alex, could you explain to viewers, perhaps, who might not realise exactly what that means, what it is to be a Special Situations Manager?
So I think in the investment industry, special situations can mean many different things. But to me, and the setup of the funds that I manage, it's very much a value contrarian strategy. And what that means is looking for things that other people aren't looking at, that other people have sort of tossed aside. And generally, because that's been done by others, those stocks are cheap compared to their intrinsic value. And our job is to sift through those rejected ideas, trying to look for ones where we think actually that countervailing consensus is wrong and actually some sort of real gems are at very low valuations, and buying those stocks.
Because some of them might just be cheap for a very good reason, presumably, but some of them are cheap because they've fallen out of favour, the sentiment is just wrong, or people just don't quite realise that there's something that company does that actually isn't being appreciated at that moment in time.
Yeah, that's very much correct. So the idea is you're sort of sifting through that sort of metaphorical reject bin. Where are the real gems, and where are the things that the consensus is rightly rejecting because there's something sort of structurally wrong with that company. And actually I find that there's quite a high percentage where things have just gone wrong, either for operational reasons that can be fixed, or the sector itself is unfashionable, or actually sometimes just the business model is unusual or complex. And if you don't have a large amount of analysis sort of help for the fund manager to really understand what's going on, people will just sort of brush past that and look at another company that's maybe more simple to look at.
And what was it that attracted you to value investing in the first place? Why did you decide to become a value investor rather than going for growth or something like that?
I think if you look over the long term, there's an awful lot of academic literature out there, and indeed I did economics as a degree, that value investing is a strategy that pays off. So you look at sort of Graham and Dodd, Warren Buffett, over time buying the cheapest companies has been a winning strategy. But also I think it's not for everyone, because it is also an unfashionable strategy. So you're looking at stocks that other people have rejected. So I think you have to have an ability to be willing to have your own convictions, stand out from the crowd, and actually sort of think that you're right compared to an overwhelming consensus that actually you're wrong. And so I think it does take a certain personality to be able to be a value investor, along with obviously having the ability to run the numbers, etc.
And where do you sit on that sort of scale between the kind of deep value investor, the sort of classic early Ben Graham example of picking up pennies in front of a steamroller, or more the sort of Warren Buffett kind of value investor, who seems to be much more a kind of value and quality, and if he thinks something that other people might think actually is quite expensive, he says, no, that's good value because that's a really consistent brand?
So I'd be much more towards the deep value end, in terms of I'm not looking for the world's greatest companies. What I'm looking for is companies across the quality spectrum that are trading below their intrinsic worth. And so I particularly like very cheap companies trading below their book value or liquidation value, because I always think about downsides on stocks. So if you're below liquidation value, and actually just today we've got about 14 of the companies in the fund below liquidation value, those are really exciting to me. But then I will buy more high quality companies if they're currently not being priced as more high quality companies. But there has to be the potential for me to see the returns or the profits of companies to increase. I'm not going to buy a company, as actually Warren Buffett will do today, just because he thinks it's a very high return company that over time continue to see those high returns. That's not the kind of thing that interests me.
And when you go looking for an investment opportunity, is it at the company level that you start, and how do you go out and find those companies in the first place before you then start delving into them and working out, yes, actually this might be the one to add to the portfolio?
Yeah, so it's very much a bottom-up stock picking fund. So we think very much about the micro level, the company level, and also we're very diversified across sectors, across geographies in terms of where revenues are earned. Got about 100 companies in special situations today. And I've got a great resource at Fidelity to help me. So We've got about 40 analysts that cover stocks across Europe, about another 40 in London that cover emerging markets and the US market. And then we also have offices in Asia. So we really have the whole world covered in terms of the investable universe. And they are a key source of ideas. So I like to see them coming up with ideas that have been doing badly, but where they think there's a potential change of fortunes. And that's very much where the work starts, sort of companies which are cheap that could improve. And then we meet the companies firsthand, do a lot of due diligence around the industry as well, so meet competitors, meet suppliers, talk to industry consultants, go and do site visits to get a lot of confidence around the changes we're hoping for, and that's where sort of the bigger positions come, where we've done the due diligence on the potential changes, we've got confidence, we buy into sort of big positions then.
Do you buy, because obviously it's quite a fairly long list of companies that you invest in, do you tend to buy in at a fairly low level and then build a position, or do you just go straight in with a bigger chunk?
Yeah, so we tend to build in gradually. So the typical position size is obviously sort of 1.5–2% at maximum, in terms of the more mid and small caps, and more up to sort of 3–4–5% positions for some of the more large caps. But I'll rarely start at that. I'll start at maybe a 0.5% position after we initially meet the company. As we do those follow-up due diligence meetings, there may be 4 or 5 of those. If those are all coming back positive, we'll tend to build the position quite quickly. More often than not, though, it's quite nuanced, so maybe 3 of the 5 are positive, and so we'll build more gradually, wait for more confirmation to happen in the market, wait until we can do more meetings. Sometimes, actually, we'll buy a position, and that due diligence will come back negative. So actually, we'll sell the initial position, because we're not just looking for cheap stocks that we hope will get better. We need to have confidence that things actually will get better.
And I think what you were saying there about building positions is something that I think as a private investor is quite difficult to do. I certainly find it quite difficult. If you go and you buy some shares because you think, oh, that company looks good, it looks cheap, or it looks like it's good prospects, but then the share price starts to go up and you think, oh, well, I should have bought more of it when it was cheaper. If the share price does start to move up and it's up, say, 5, 10, 15%, will you still continue to build the position even though it's more expensive now?
It depends on what's happened, and in terms of sort of, are we getting more confident in the change story or not? To be honest, it's not that often that shares will start to work quickly, and that's part of the reason why I build the position slowly. Actually, typically, stocks will underperform after I first bought them. So then the question is the thesis in terms of the change story still possible? Is there still good downside protection in terms of, is the balance sheet still strong? Is the underlying fundamentals over the medium term still there? If so, that's a great opportunity to buy more at lower prices. Similarly, though, if something happens quickly, then I will buy more even if the stock's gone up. And it's all about sort of how much upside I think there is. Okay, maybe you're getting less than if you bought it all initially, but it doesn't mean it's not a good investment today if there's still upside just because it's gone up.
Mm-hmm. And you're predominantly invested in the UK, that's correct, isn't it?
Yes.
In the fund and in the investment trust, but with a bit overseas. Where do you see the opportunities at the moment in the UK, and then where are you adding to that from overseas stocks as well?
Yeah, so the FTSE is an unusually diversified index from a geographic point of view. So even though the fund has to have 80% invested in companies quoted in the UK, when you look at those companies, actually only about 30% of the earnings of the UK index are from the UK. The other 70% is overseas. So you get an awful lot of overseas exposure just by owning UK companies. And when you look at special situations today, we've got about 38% facing the UK market, even though we've got about 15% in the fund invested in companies which aren't quoted in the UK. So we're actually overweight compared to the index on UK geographic exposure. And the reason for that is, first of all, there's a slight structural reason. So we've got more mid and small cap stocks than the index, and they tend to be more biased to the UK. But then also, and particularly so since the EU referendum, UK-facing assets are at quite steep discounts in terms of their valuation compared to international-facing assets. So likes of sort of Lloyd's, which is a big position, that's on about 8 times its current profits, or PE, whereas HSBC, a somewhat similar banking business model facing global markets, business on 14 times earnings. So yes, there clearly is some uncertainty about the UK economy and uncertainty about the Brexit process, but the market is very significantly discounting UK facing assets because of that, and that's one of the reasons that I'm overweight.
And so there's more potential for an upside in the UK because it's already being undervalued, essentially.
Yeah, I think as I sort of talked on a stock level basis, it's almost like on a sort of country basis, the UK is undervalued because of that greater uncertainty. So the consensus is Brexit is not going to go smoothly. I don't strongly agree or disagree with that, but it's very clear that's what the consensus is because you can see it in the valuations. So I think if the talks do go badly, the UK doesn't get a good deal or doesn't get a deal, that's what the stock prices are telling you. Whereas actually if things work out, that's not consensus, so there could be a lot of upside.
In terms of some of the companies that certainly I think the more consumer or UK facing companies at the moment, there seems to be something of a phenomenon, and maybe we're just noticing it more, I don't know, but where a company brings out some kind of bad results, or they don't even necessarily have to be that bad. It doesn't even have to be a profit warning. It's just they don't quite meet expectations. They say maybe the next year's not going to be that great, and the share price gets really quite hammered at the moment. You know, drops of 20, 30% in one day. If a company, if you see that kind of scenario going on, is that something that sets the lights flashing to go have a look at that company? Or is it actually something that sets the lights flashing that says, oh, actually, that company's probably got more bad news before it then starts to be investable?
So I think there's a sort of an adage that profit warnings rarely come in ones. They're like buses, they're sort of three come along. So actually sort of investing after one profit warning is often a bad idea. That said, it does pique my interest. So when a company underperforms significantly, it's often a spur for me to start looking at that company, but rarely do I buy it quickly. It's sort of working out what's going on, what's now being discounted. I think also, though, when you look at some of the companies that have been having profit warnings, particularly some of the retailers, you do have to bear in mind that I think the reason for some of the strong negative reactions is that as a sector that doesn't just have sort of uncertainty from an economic point of view because of the Brexit process, but also has structural issues. So in terms of clearly retail is going online, most of the quoted retailers are primarily offline businesses, and so structurally they are losing market share. And so I think you have to be quite careful investing in the retail space, even though I think, yeah, the cyclical pressures are well known. Those structural pressures aren't going away irrespective of what happens with the economy. And so clearly retail is a sector where I would sort of say you have to be much more careful about structural losers rather than companies that can turn around and improve in future.
And one of the things that you tend to hold in a fairly decent quantity in the fund and the trust, and you alluded to earlier with Lloyd's, is banks and financials. What is it that appeals about them at the moment?
So I guess financials as a whole has been a big weight for me over the last 5 years, and actually has been a source of a key number of my outperformers. So 4 of the top 10 performers over 5 years in special values have been financial stocks. And I think that's because financials continue to have a negative connotation in the eyes of the broader public and investment community because of the previous global financial crisis. Clearly the banks' misdeeds before that were in many ways responsible for those events, and therefore people continue to shy away from the sector as a whole. Additionally, I'd say the sector is very complicated, so not only banks but also diversified financials, insurance. These business models are difficult to understand, so many investors that don't have the wide analyst team that we have Fidelity simply go past them to look at simpler businesses where they think they can add more value. And I think it's that combination of, first of all, unpopular because of overriding sentiment and negativity and complexity that gives you the real standout opportunities. And indeed, you're right, I've got about 38% of the fund invested in financials today across banks, insurance and diversified, and that's by far and away the largest sector weight.
And sort of away from those, which are the largest sector weight, is there any other sort of one sector within there or one example of company at the moment that you think actually that could be something for the next year or two that outperforms?
So a big new position that I've added to recently is Pearson in the education space. again, like many of my stocks, has been a very poor performer prior to purchase. Over the last 5 years, the company's down about 70%. If you look back 5 years ago, almost all the people who are analysing the stock from the sell side at stockbrokers, they would have said this is a great company, structural growth of education over the longer term, the value of education only goes up over time. Pearson is a global play on that, primarily with the US as their biggest market being the biggest global education market. Now, that's completely changed, and actually almost all the stockbrokers have the company on a sell because they say it's a structurally challenged business, that the business model is broken, and that the company over time is going to completely lose its relevance. Now, I think that's an incorrect view. I think what's happened is people have really missed the cyclicality in the education market. So people go into education more when the economy is bad, when it's difficult to get a job. And that was particularly the case in the global financial crisis, where unemployment rates really skyrocketed, and people in the US particularly enrolled in 2 and 4 year education courses, particularly in the for-profit sector. And actually there was a bit of a bubble in that sector. So some of the very high growth rates they saw through 2009, 2010, 2011 were really a bit illusionary, and those have come off. Education enrolments have fallen quite a lot as we've gone to sort of record low unemployment levels, and that's very negatively affected the company's top line. There's also been some shifts from traditional textbooks to more online. That's required a big investment in online, but actually not able to take out all the costs of the textbooks because you need to publish both. So not only has the top line been under pressure, but margins have been under pressure as costs have built up. But I think from here, what's really interesting is you're at record low unemployment, so I think the cyclical headwinds are starting to abate. Much more of the business is now online, and they're starting to be able to take out some of that fixed infrastructure from the textbook side. So I think in 5 years' time, this could once again be seen as a very high-quality structural growth company, despite the fact today it's on about 12 or 13 times earnings, so a massive differential from the 18, 19, 20 times people are paying today for steady staples businesses, which are viewed as structural growers.
Alex, that's all we've got time for today. Thank you very much for joining us in the studio. Thank you very much for watching. Join us next time on The Investing Show. Goodbye.